These are 8 top big cap stocks with large percentage gains today. Our review on ELPW. eLong Power Holding Ltd has certainly had an eventful day in the market, with the stock surging 50% today, with a pop-and-drop breakout of over 50% in the early hours of regular trading. The company, which specializes in high-power lithium-ion batteries, is gaining attention for its role in the electric vehicle, EV, and energy storage markets. With a portfolio that includes lithium manganese oxide and lithium iron phosphate batteries, eLong Power is aiming to meet the growing demand for energy storage solutions in EVs, construction machinery, and large-scale energy systems. That initial 50% jump caught many investors off guard, and it's likely tied to excitement surrounding the company's positioning in the booming clean energy sector. Lithium-ion batteries are key to the future of energy storage and EV infrastructure, which makes eLong's technology and product offerings particularly relevant as the demand for sustainable solutions continues to rise. However, the subsequent drop in price suggests a lot of uncertainty or caution in the market. Investors might be trying to assess whether the initial excitement is warranted or if there's more risk involved, especially considering the company is still working on scaling production and competing with other players in the field. While today's price action shows the volatility that can come with emerging technologies, eLong Power's focus on long-cycle, high-power batteries places them in a strong position within the renewable energy space. Still, the market's reaction today highlights just how quickly sentiment can shift, especially for companies in a high-growth, high-competition industry like this one. For investors, it's important to keep a close watch on the company's upcoming milestones, how they handle production scaling, and their ability to capture market share in this rapidly evolving sector. The pop-and-drop dynamic is a good reminder of the unpredictable nature of the market, especially in the clean energy space. Our review on TMC. TMC, the Metals Company Incorporated, has seen a major boost today, with shares climbing 45% during regular market hours and then adding another 20% in after-hours trading. So what's driving all this excitement? It's tied to some major developments in the global market for critical minerals, especially after China imposed new export restrictions. As we know, these minerals like nickel, copper, cobalt, and manganese are in high demand, particularly for use in electric vehicle batteries, renewable energy storage, and a range of other tech and infrastructure projects. TMC is one of the companies positioning itself as a major player in this space, with a focus on deep-sea mining in the Clarion-Clipperton Zone in the Pacific Ocean. This region is rich in polymetallic nodules, which contain those very minerals that are so critical for the green energy transition. Now, this is where it gets really interesting. The Trump administration is reportedly working on an executive order to stockpile these deep-sea metals as part of a broader strategy to reduce reliance on China for rare earth supplies. This could be a huge opportunity for TMC, as they've got access to a potentially massive untapped resource right at the bottom of the Pacific. With China having already restricted the export of several key rare earth elements, there's a growing sense that the U.S. needs to ramp up its domestic supply chain for these crucial materials. And that's where TMC could come in, especially if they can successfully scale up their deep-sea mining operations. All of this is creating a perfect storm of excitement around TMC. Investors are clearly betting on the future of deep-sea mining and the role TMC could play in securing the metals that are vital for the next generation of tech, electric vehicles, and clean energy. It's a sector that's definitely gaining attention, and TMC, with its lower-impact mining approach, seems to be right in the sweet spot to capitalize on the global shift towards sustainable resources. If they can navigate the complexities of mining in the deep ocean while scaling their operations to meet demand, TMC stock could keep gaining momentum. It's a fascinating time for the company and for the market as a whole, and definitely one to keep an eye on as we move towards a more electrified, sustainable future. Our review on I-Mab. I-Mab, a global biotech company known for its innovative immunotherapies, is having a great day in the market, with shares up 42%. This surge comes as the company's exciting pipeline of cancer treatments continues to draw attention from investors and analysts alike. I-Mab is focused on developing highly differentiated biologics, and it's making waves with its clinical stage pipeline. A standout is uliledlimab, TJD5, a humanized antibody targeting CD73. This molecule plays a key role in converting extracellular AMP to adenosine, which tumors use to suppress immune responses. By inhibiting this process, uliledlimab is designed to work in tandem with checkpoint therapies like PD-L1 inhibitors, potentially boosting their effectiveness and offering a new approach to treating cancers. But that's not all. There's also givastomig, TJ-CD4B, a bispecific antibody targeting Claudin 18.2 positive tumor cells. It has a unique mechanism, activating proimmune 4-1BB in the tumor microenvironment, which could significantly improve immune response against these tough cancer cells. Then there's ragistomig, TJL14B, another bispecific antibody designed to target PD-L1-resistant tumors, critical for overcoming the limitations of current immunotherapies. With these therapies showing promising clinical progress, it's no surprise that investors are getting excited. I-Mab's focus on novel, highly differentiated treatments gives it a solid footing in the competitive biotech space. The 42% jump today reflects the market's growing confidence in the company's ability to bring new, game-changing immunotherapies to the table. If I-Mab's pipeline continues to advance, this could be just the beginning of even bigger gains. It's a company to watch closely, especially if you're interested in the next wave of cancer treatments. Our review on USAR. USA Rare Earth Incorporated, a company focused on securing the U.S. supply of rare earth metals, is seeing a big boost today, with shares up 41%. The reason? A mix of rising geopolitical tensions and China's recent decision to impose export restrictions on critical minerals, a move that's shaking up the global market. With China controlling around 90% of the world's refined rare earths, this development has put the spotlight on companies like USA Rare Earth, which are working to create a domestic supply chain for these vital materials. The company is in the process of building an NdFeB magnet manufacturing plant in Stillwater, Oklahoma, which is part of its broader strategy to reduce U.S. dependence on foreign rare earth supplies. With demand for these metals skyrocketing due to their use in electric vehicles, wind turbines, defense systems, and consumer electronics, securing a stable, domestic supply of rare earths is more important than ever. USA Rare Earth's vertically integrated approach, sourcing materials, processing them, and manufacturing finished products, puts it in a strong position to capitalize on this growing need. What's driving the stock today is more than just the geopolitical climate. USA Rare Earth's efforts to produce critical minerals like gallium and rare earth elements for its magnet plant are aligning perfectly with the U.S. government's push to secure domestic mineral production, which has only increased as China's actions make the world more aware of supply chain vulnerabilities. So, with the current buzz around critical minerals, particularly after President Trump's rumored executive orders to stockpile these materials, USA Rare Earth is well-positioned for future growth. Investors are clearly taking notice, and the 41% jump in share shows that the market is reacting to this new sense of urgency around securing a domestic supply of rare earths. If USA Rare Earth can continue to ramp up its operations and deliver on its goals, we could be seeing even more upside in the future as the U.S. pushes to become less reliant on China for these critical resources. Our review on MB. Masterbeef Group, the Hong Kong-based restaurant chain founded in 2019, has been catching a lot of attention today in the stock market. Known for its Taiwanese hot pot, barbecue, and other comfort food offerings, the company operates a variety of restaurant brands, including Masterbeef, Onping Grill, Chubby Bento, and Bao Pot. After launching an $8 million IPO, the stock initially took a dip, but quickly turned around, with shares up 41%, including a major 40% breakout around lunchtime trading. The rapid rise in its stock price today has definitely put Masterbeef on the map, and it seems like retail investors are jumping on board, likely fueled by a mix of enthusiasm and the belief that this restaurant chain could have strong growth potential. For a relatively young company in the restaurant sector, attracting retail investors is a big deal, especially after a somewhat shaky IPO performance. This surge could indicate that investors are seeing something promising in Masterbeef's future, particularly in its ability to carve out a niche with its Taiwanese-focused menu. Despite the volatility that often comes with IPOs, today's surge in Masterbeef's stock price suggests there's more than just a quick post-IPO bump. It signals a potential turning point for the brand. The company's diverse menu and the popularity of its various restaurant concepts are definitely appealing, especially as people continue to seek out new dining experiences. Taiwanese hot pot and barbecue are well-loved, but not necessarily mainstream in every market, which could mean Masterbeef has room to grow, especially if it can continue to capitalize on the current consumer appetite for different culinary experiences. Masterbeef's focus on delivering both high-quality food and a variety of dining experiences positions it as a strong player in a competitive space. But the key will be in how it handles expansion. There's a lot of potential if it can keep up with its brand development while maintaining consistency in quality and service across its restaurants. The 41% rise today shows that investors are intrigued and hopeful that Masterbeef can tap into a bigger market, potentially going beyond its current reach in Hong Kong and expanding further. For now, this stock surge seems like a positive sign for the company, but it's still early days. If retail investors continue to support the stock and the company can deliver on growth, it could be on the path to bigger things in the coming months. Masterbeef has a lot of eyes on it right now, and it's all about whether it can sustain this momentum and prove it has staying power in the competitive restaurant sector. Keep an eye on this one. It might just be getting started. Our review on GGR Gogoro Inc, the Taiwan-based company known for its smart, interchangeable electric fuel and light urban vehicles, is making waves today with a 35% jump in its stock. The company has developed a unique ecosystem around its electric scooters and battery swapping stations, offering a fast and efficient solution for urban transportation. Gogoro's Swap and Go system, already in use in Taiwan, is a big draw, allowing users to quickly swap out batteries instead of waiting for them to charge, a real game changer for city dwellers. This morning, Gogoro saw a 30% breakout right after market open, catching the attention of investors. It's clear the market is buzzing about the company's potential, especially as the demand for sustainable electric mobility solutions continues to grow. Gogoro's focus on battery swapping and its ability to scale up its infrastructure gives it a significant edge in the EV space, particularly in crowded urban environments. With its innovative approach and strong momentum, Gogoro seems to be in a great position to capitalize on the growing trend toward green technologies. If the company can keep up this momentum, investors are betting that Gogoro is just getting started. Today's spike shows that there's a lot of excitement around the company's future, and it could be one to watch closely in the coming months. Our review on WGRX Wellgistics Health Incorporated, a company that operates through a mix of subsidiaries focused on specialty medications, is having quite a moment today with a 32% spike in its stock price. The company is making waves by providing innovative health solutions through its technology platform, DelivMeds, which connects patients to a seamless pharmacy experience with home delivery services. The idea behind Wellgistics is to simplify the prescription journey while improving access and transparency for patients, which is clearly resonating with the market. What's particularly exciting for investors is Wellgistics' focus on both technology and patient care. The DelivMeds platform is a game-changer, offering an end-to-end mobile solution that digitizes the entire prescription process, from ordering to delivery. This has the potential to disrupt the way patients interact with pharmacies and pharmaceutical providers, making it easier, faster, and more transparent. On top of that, Wellgistics offers medications like Kizotrex and semaglutide, which are gaining traction in the specialty drug market, especially with the increasing demand for weight management and diabetes treatments. The stock's jump today shows that investors are taking notice of the company's unique approach and the promise it holds in transforming the healthcare experience. If Wellgistics continues to expand its platform and solidify its place in the growing specialty medication and home delivery space, this could be just the beginning of its run. Investors should keep an eye on how Wellgistics grows and scales its operations in the months to come. It's definitely a stock to watch right now. Our review on THTX. Theratechnologies Inc, a Canadian-based biopharmaceutical company focused on developing treatments for unmet medical needs in areas like HIV, NASH, and cancer, is making some big waves in the stock market today. The company's shares are up 32%, with a strong 25% breakout right from late pre-market trading into early regular hours. What's driving this surge? A high-profile acquisition proposal from FuturePak, which is offering a significant premium of $3.51 per share. This offer represents a whopping 163% premium over Theratechnologies' last closing price on April 10th, sparking a lot of investor interest and sending the stock soaring. The acquisition bid has been backed by Soleus Capital, a healthcare-focused investment firm that owns more than 10% of Theratechnologies. In a letter to the company's board, Soleus Capital urged them to seriously consider FuturePak's offer, arguing that it represents the best value for shareholders. They've pointed out that the company's management has been slow to engage with potential acquirers in the past, suggesting a reluctance to entertain offers that might benefit shareholders in favor of management's job security. Given the all-cash nature of the FuturePak offer and the sizable premium, Soleus Capital believes that it's a clear win for investors. Theratechnologies has a lot going for it with its existing pipeline, which includes products like Trogarzo for HIV and Egrifta SV for abdominal fat in HIV patients. They're also advancing their clinical trials in non-alcoholic steatohepatitis, NASH, and oncology. However, today's market reaction seems to show that investors are more interested in the immediate, tangible benefits of this acquisition than the company's long-term prospects as a standalone entity. If this deal goes through, it could result in a major payday for shareholders as they stand to receive a generous premium for their shares. The focus is now on how Theratechnologies' board will handle this acquisition proposal. Will they accept it, potentially giving shareholders a quick, profitable exit? Or will they continue to pursue their own growth strategy, which might take longer to bear fruit? Either way, this deal has definitely captured the market's attention, and the next steps will be critical for the company's future and its investors. Please subscribe, give the video a like, and watch more from our playlist. Thanks.